What we're seeing is we are seeing some recovery there. In terms of the transaction volumes that we're seeing happening in the market, that is mainly coming from domestic capital at this point in time. But as interest rates, the Fed obviously signalling that they're probably going to adjust by 25 bips or 50 bips next month. Typically, the US market is a signal to real estate markets generally globally in a recovery. When we see interest rates move in the US, we then see the markets recover. And indeed, if you look at what's happening in terms of flowing through to the volumes here in Asia-Pacific, we've seen in the last quarter volumes improve by about 2% in the last quarter here in APAC. So volumes about 27 billion US dollars. That's the third consecutive quarter of recovery that we've seen there. What we expect to see flowing through as we go through into the end of this year, into next year, is that recovery to continue to accelerate, to be honest.
And, Roddy, is there anything in the internals of this index that are flashing any warning signs at this point in time about defaults, delinquencies and the credit cycle as it applies to real estate in a lower growth environment and in a lower rates environment?
Sure. I mean, not within the index itself. I think the one thing that jumps out to me in terms of a stat is just the amount of debt that's due to be renewed over this year and into next year. So you're talking about 1.2 trillion US dollars worth of debt, about 30% of which has been essentially we've gone through already. I think the lower interest rate environment will help, but in terms of the renewal of those debts, they're still going to be renewing at a higher interest rate, and that's where the private equity markets are beginning to step in. Now, probably the question around that is the transparency of those private the debt markets, because essentially they're not as transparent as typical lending.
Mandy has a question, Roddy.
Hi, Mandy.
Yeah, actually, I was going to ask you about that because I'm not sure we've entirely seen the full brunt of the so-called mortgage cliff, whether it's residential or even commercial real estate, as so many of those mortgages essentially roll off into much higher rates. Do you think that that's going to hit hard in 2025, and because of the lack of transparency, as you say, in the private credit lending markets, are we not prepared for it in the way that we should be?
I think that's less of a concern, to be honest, Mandy, here when it comes to Asia-Pacific. I think we're beginning to see markets recovering. I mean, in Singapore, I think the transaction volumes that we've seen have been constrained. Certainly, the recent transaction volumes that we've seen coming through about 2,500 units there, and that's down by about 56%. But that's really been constrained, to be honest, by the lack of available product in the market, and that's beginning to open up. So we'll see volumes coming back there if we talk specifically about Singapore. Interest rates, of course, constraining the market a little bit. Again, if we look at markets like Hong Kong more subdued, I mean, we do expect the Fed to adjust the interest rates in the US, which will flow through to Hong Kong, but probably not going to make a significant difference there. But in general, across the residential markets in APAC, other than Greater China, still looking relatively healthy. And I think as we move into 2025, we would expect to see a recovery there. I mean, primarily what we're tracking is the primary market for luxury residential.